At IB Canada Group, we are your complete and independent source on the infinite banking concept, serving Canadians from coast to coast.
Hi guys, my name's Donovon Coates, and I'd like to talk really quickly about the benefits of compounding interest as well as the problems of compounding interest. To do that, I'm going to talk about the banker's rule, also called the rule of 72. It's a simple formula and it's fairly accurate. So what you do is you put your rate of return, or whatever the interest rate that you're getting on your investments, put it into 72, and that gives a number of years it takes for your money to double. So if somebody's getting a 10% return into 72, that equals 7.2 years. That's a very simple, basic calculation, but it takes about 7.2 years for that money to double. So if you've got $10,000 in your account, right? 7 years later, you're gonna have 20,000. 7 years later, you'll have 40,000. 7 years later, you'll have 80,000, right? So by this time, you've got 7, right? You got 14, 28 years. So from somebody's 20 years old, 28 years later, they're almost in retirement. If they had an inheritance of $10,000, now they've got $80,000. It does take time to build wealth sometimes. If somebody's only got a 1% return, that's going to take 72 years. So everybody has a calculator. They can put in their own rate of return, what they're getting on their investments. So that's a good thing, right? If we have predictable rates of return, cash flow, we can calculate what we're going to get and when. And remember what I said, the banks use this. So how much are we getting on our money? Generally very low interest rates at the bank. It's going to take a long time. 1%, 72 years. 2%, 36 years. So they're offering us high interest rates. It's going to take a long time. When you take over the banking process, you make the money. Having said that, the problems with compounding interest is what the banks do on your credit cards. So let's take that 20% ROI into 72. What does that equal? 3.6 years. So for some reason, you have a $10,000 credit card, 3.6 years go by, it's going to be $20,000. Another 3.6 years go by, $40,000. Now it's not quite that simple, but if somebody's only making minimum payments, you can see that in as little as 7.2 years, you're already at 40,000. Remember and figure out what you're getting for a return and create that debt. If we can recover that interest is the whole point. Don't give it to somebody else's bank, bring it back for yourself. Because listening to what the banks say is destructive to your financial well-being. Creating your own banking system, as you can kind of start to see here, is so much more beneficial. All right, have a great day. Thank you.
IB Canada Group, your independent authority for information on the infinite banking concept.